Okay, so now we are going into another title. In fact, the things that we learn up to now, the market, some concepts in the market analysis, as well as the production and the cost of production will be taking into the discussion in this topic or title. Some applications will be done here. So the market structures, this is a very big topic. In fact, for ENMS students, they are having one course in their second year on market structures, but still we are teaching only 5 of them. There are large number of market structures. So market structures mean how our decisions be made, especially quantity and price. Right? How we make the price and quantity decisions in the market, and depending on those decisions, what is happening to our profit. So are we having economic profit or not having economic profit? Can we have some losses? Likewise, these titles will be discussed under this subtitle. So under market structure, there are two major market structures called perfectly competitive. As the word itself says, perfectly competitive means there will be a huge competition in the market. The other one is the monopoly, where we will not be having any competition, because monopoly means we are having only one producer. So later I will discuss about this. But there are two extreme ends. On one end, we are having perfectly competitive market structure, where all the producers and consumers together decide the price and quantity. They get together and decide. No individual can make any impact under perfectly competitive market because it is so competitive. Individual player cannot make any change in the market. On the other hand, when we say monopoly, there is no any competition. We have only one supplier. Then there is no any competition. He or she will determine the price as well as quantity. So depending on these decisions, our profits may be changed. But remember, both perfectly competitive market and monopoly market structure are not real. We don't see perfectly competitive market in real world, pure. Right? And also we don't see pure monopoly in real world. But when you learn about perfectly competitive market as well as monopoly market structure, then it would be easy for you to analyze the real market scenario, because real market scenario will be in between the perfectly competitive and monopoly. So perfectly competitive market and monopoly markets are very hypothetical, theoretical. But once you learn them, then you can understand anything in between them. If your market structure is getting more closer to perfectly competitive, many of the characteristics of the perfectly competitive market will be applied. If your market is getting more towards the monopoly, then the characteristics of the monopoly market will be applied there. And therefore, it is mandatory for any economic students to learn these two market structures, monopoly and perfectly competitive. So in your course, we are trying to give you monopoly and perfectly competitive market structures. So let's start with perfect competition. Why we call a market perfectly competitive? There are several reasons. So I have listed out here some of the major reasons why we call a market a perfectly competitive market. We call them as assumptions. So we are having several assumptions about the perfectly competitive market or characteristics. If we are getting these characteristics, then we say, yes, it is a perfectly competitive market. So let's see what are those. The first one, there will be a large number of small sellers. There will be a large number of small sellers. Look clearly, it says a large number and small in size. So what do we mean? What do we mean by a large number of small sellers? So let's say paddy farmers, they are small in size. Right? On average in Sri Lanka, paddy farmer cultivates 1 hectare, which says 2.5 acres, maximum 2 hectares. So they are small in size because we are cultivating millions of paddy lands or hectares. But a single farmer produces only 1 hectare. And they are small, size is small. So what do we mean by a large number of small sellers? We assume that the market share for a particular supplier will be very small. And we have a large number of such producers. So there will be millions of producers, but they are small in size. Individually, they cannot make any impact in the market. Take, since Kavishka put this example, paddy farmers. Let's say one paddy farmer, he thinks he doesn't want to cultivate. He wants to make some impact on price. So next year, he is not going to cultivate and stay away from production. If he stay away from production, will it make any impact in the market? Will the price be increased because of supply decrease? Of course, no. It doesn't matter because his supply is so small, nobody cares. So if he does not want to produce, he will stay out from the market, no issue at all. On the other hand, let's say this farmer wants to double his output to make some impact in the price. Right? The farmer will have 2 hectares and put his paddy out to the market. Does it make any impact in the market? Still not. Right? So there will not be any impact from individual supplier. This is because he is so small in the production. The same way we have a large number of small buyers. Not only one buyer. There will be a large number of small buyers. Many people will be coming and buying it with small quantities. So if single buyer say, I'm not going to buy, it doesn't matter. It doesn't make any impact on the price. So the two important assumptions in the perfectly competitive market is a large number of small buyers and a large number of small sellers. The classical example, in fact, what I am taking is the vegetable market in Sunday Fair, Badulla. You may have been to some of the Sunday fairs in your area. And just imagine the picture about the vegetable, let's say carrots. So we want to analyze the market behavior of the carrot market in Badulla Sunday Fair. Oh, whatever the fair you want, you have been. There will be a large number of small sellers. One person will sell like 5 to 10 kilos of carrot. Such producers, there will be more than 100 in the Sunday fair. Everyone sells a very small amount. Then, if a producer thinks, I want to increase the price today, the market price is 100, and the producer will say, I'm going to sell it 120. So he will start shouting 120, 120 because he wants to increase the price. Will he be able to do that? Of course, he will not be, because all the other people, 99 vegetable suppliers, they are selling carrot at 100 rupees. So the consumers will not come and buy from this guy for 120. So his stock will be there without selling. On the other hand, let's assume another guy, he wants to go home early. He decided to sell his carrot for 80 rupees. So he will be starting. I'm selling it at 80 rupees and so on. So what happened? Maybe 2-3 people quickly, when they hear that it is 80 rupees, quickly they get into this place and buy out everything. So maybe after 5 minutes or 10 minutes, all his productions may have gone. Right? So therefore, we can conclude with the first assumption: a single producer cannot make any impact in the market. On the other hand, the buyers are also the same. One buyer will come and say, I'm not going to buy today because you are telling 100, I'm telling 75. I have no money, I have only 75. If you are telling 100, I am not going to buy. Will there be any impact in the market? There will not be any impact because he is buying only 500 grams or 1 kilo of carrot. But there are many other thousands of consumers are there who is buying another 500, 1 kilo, 2 kilo, likewise. This guy is also only going to buy 1 kilo of carrot. So then suppliers will say, okay, if you don't want, you just wait. We are selling at 100 because there are some other people who are willing to buy that at 100. On the other hand, let's say now this guy is so much happy. So he got some bonus or something, so he is very much happy and get to the Sunday fair. And he finds the carrot, he will say, today I'm very much happy, so I'm going to give you 125 rupees per 1 kg of carrot. So what happened? The supplier will say, very good, here it is, and will be taking 125. But all the other people, they demanded 100. So can this supplier tell that guy is all took it for 125? All the other people should take it at 125. It will not happen because his amount of buying is very small. Maybe he took just only 1 kilo. So if he is taking only 1 kilo, then others may not care about that. So therefore, with large number of small sellers and large number of small buyers, we assume both sellers and consumers, or producers and consumers, sellers and buyers, they are small in size. They cannot make any impact on the price. So price will be determined by the market, altogether by the producers and the consumers, and that price will be accepted by all the people in the market. The third assumption is producing homogeneous products. What do we mean by homogeneous product? Homogeneous product means they will be the same. The shape will be the same, quantity will be the same, wrapping will be the same. So everything will be the same. But if you take my example, carrot. Carrot in Badulla Sunday Fair, if you look around, it is the same for everywhere. Because we have one wholesaler who come by his lorry and give small quantities to the sellers. So therefore, if you look at, carrot will be the same. They will be same in size, same in quality, same in color, same in wrapping, and so on. So we say that we are having homogeneous products in the perfectly competitive market. Maybe one good example. Sorry. These days, it is not common, but if you remember before pandemic, there were lot of canned fish in the supermarket. If you get in the supermarket, maybe 3 or 4 racks dedicated for canned fish. If you look at the canned fish clearly, you find that they are same in size, same in quantity, Same in the wrapping, like, red and yellow color wrapping. Size also the same. Shape also the same. Everything is the same. So then we call homogeneous product. In fact, quality also the same. If you look clearly, other than the Sri Lankan canned fish, all the other canned fish are originating from the same place in China. So we import the canned fish without that label from China, and in Sri Lanka we put the wrapping. So two companies, they import from the same producer. Therefore, inside also we get the same. So we say these are homogeneous products. And we are having one more assumption, important, called no entry and exit barriers. Right? So in a perfectly competitive market, there are no barriers. If anyone interested in supplying something or selling something, what he or she can do, he or she can get joined with the business. Like take my case with Sunday Fair. If you are interested in selling vegetables, maybe in future, it will be much better than lecturing, right? Selling vegetables, because vegetable prices are getting so high and the profit margin may be so high. Therefore, let's assume I want to get into the Sunday Fair. No issue. I can just go there and buy carrots from the wholesaler and sell carrot in the market by paying some, rent. I have to pay maybe a small amount to the urban council as the rent. Other than that, I can sell whatever I want in the Sunday Fair. At the same time, a current or existing producer or the seller, if he feels he want to leave the place, still there is no any problem. He can just get away from the market and stay away from the market. So this is called no entry and exit barriers. This is very important condition with the perfectly competitive market. Anyone can join as he wish. Anyone can leave the place as they want. So there will be no entry and exit barriers. And finally, free and quick information flow. In the perfectly competitive market, it is very important to have free and quick information flow. If we are getting a cheaper price in one place, we should be quickly get those information. Then all the customers will get into that place and buy from that place because it is cheaper. And so to make the comparison and to make the decisions of the consumers, there should be quick information flow. In fact, in Sri Lanka, it was very rare, but now it is there. If you take many of the supermarkets, they send us even a message to our mobile phone every day, telling about their prices. It is free. I have no any cost involved with this one. Of course, if it is a mobile phone, then data charges will be there. But they will send free of charge about the market information. If you are living in a developed country, every day you are getting the price details. In front of the supermarket, you will see what is the price today. And even the leaflet come to your doorstep. In the mailbox in the morning, I see all the details about the price changes are there in my doorstep. Right, so therefore we assume that free and quick information flow. These are the fundamental assumptions of perfect competition. And there are several other, like there is no personal relationships. There are no substitutes. So likewise, there will be several other assumptions. But we need to remember these 5 assumptions. These are very important. Then, if you are clear, I hope you remember this one. We learned this in the demand and supply analysis, which we call market analysis. In the market analysis, we had demand. like this. And then we had the supply. So we had demand and supply, and we put them together and got the price. This is called market equilibrium price. So market determine this. And this is the quantity which is also determined by the market. So I hope you remember this analysis. Right? We are having demand and also we are having supply. So then what we do, we put demand and supply together and get something called equilibrium price. And then the quantity which is selling at that time or buying at that time in the market is known as Q star, that is the equilibrium output level. Now, in perfectly competitive market, we assume this behavior. We have demand and supply together determine the price. That price is given as marginal revenue, which I discussed previously. So this price is known as MR. Why it is called MR? It is called MR because when you increase your selling, so this is about the market, this is about the market, this is about the firm. This is about the firm. Now, if market determine price as P, what happens in the market? An individual producer can sell any amount of goods and services with the given price P. For example, let's assume market determine the price as 10. Market price of something is determined as 10, and individual supplier can supply any amount of this good with the given price 10. Right? Therefore, this curve also will be the demand curve of the individual producer or individual firm. If we are having a single firm, it can supply any amount of the good with the given price P. Therefore, we say this is the demand curve of the firm. Remember, this is the demand curve of the firm. This is the demand curve of the industry or in the market. Since this is the demand curve for the firm, let's take a point like this. So let's say this is 10. So we are producing 10 output unit with price P, which also I said 10. So now we know his revenue will be 100. This is revenue, total revenue, if we are producing at 10. So simply 10 multiplied by 10, it is 100. Let's assume we increase our output by one more unit, that is 11. So 11 multiplied by 10 is 110. So we increase one unit, increment is 10. Same way, let's assume we increase one more, not 11, now it is 12. So 12 multiplied by 10, 120, and increase one unit. This is difference is 10. Likewise, if you increase your output by one unit, always, what is happening to your total revenue? Total revenue will be increased by 10 rupee. So what is this 10? This 10 is the price. So therefore, in the perfectly competitive market, we say MR equal to P. Marginal revenue, which I discussed in the previous discussion, marginal revenue means the additional revenue that we get to the total revenue by increasing one more output unit. When you increase your output unit by one, what is happening to your total revenue? This is known as marginal revenue. So that is equal to the price. This is because Only in the perfectly competitive market, this is because the producer can sell any amount of goods and services with the given price P. Therefore, whenever I produce and put that in the market, I will get market price as my additional gain. When I increase by one more unit, I will be getting the price as my additional gain. Another unit, I will be getting price as my additional gain. Therefore, remember, in the perfectly competitive market, price equal to MR. So, if you want, you can put here P equal to D of the firm, that is demand for the firm, equal to the marginal revenue. So, remember this very well. There's a question, homogeneity, is it about the characteristics of the product? Simple answer, yes. As color quantity, or the homogeneous means same product that provide the same utility. The homogeneous product can be homogeneous products. Of course, we are not worrying about the utility, but we are worrying about the characteristics. Utility may be different, can be different, but characteristics will be the same, like color, shape, quantity. Right? If the inside also the same, like in the case with Sri Lanka, of course, then we have the same utility. But in general, we say the outer shape and the quality and quantity, whatever. Because we differentiate the product with the price only. In the market, we can differentiate product with price. If the price is higher, people will go and buy that product. If price is higher, people will not go and buy from that product. If price is lower, then people get there and buy that product. So therefore, the characteristics of the good is known as the homogeneity. So homogeneity is defined by the characteristic. And then homogeneous product can be substitution good any chance. Yes, they are perfect substitutes. If you are having homogeneous products, they are perfect substitutes. This is why you cannot change the price. Let's say we have product X. This is about canned fish. One product from company X. The other product from company Y. They are same in size, same in wrapping, same in quantity, same in quality. And when we look at clearly, it is the same thing inside because we import from the same company. Now, aren't they perfect substitutes? It doesn't matter whether we are buying from company X or company Y. We are getting the same good. In fact, in this case, same utility. So therefore, they are perfect substitutes. So in other words, it says in the perfectly competitive market, we assume there are perfect substitutes. Okay. Then this one, which I discussed at the very end of the previous class, and where I said optimum output level of a profit maximizing firm will be set at the point where MR equal to MC. We learned that. MR equal to MC at the optimum point. At that point, we had the cost recovered, AVC recovered, ATC recovered, and also we had economic profit in that case. And I did not answer the question why we determine optimum output at the MR equal to MC. But I used the word profit maximizing output level. So MR equal to MC is the optimum output level for a firm. At the same time, it is the profit maximizing output level. Why it is so? It is because you just take point like this. So in this graph, we know MC equal to MR at this place. This is MR. price is here, and we know if we are working in the perfectly competitive market, no issue at all. We know E equal to MR. Simply, we can be extended as MR. So this is our MR curve, marginal revenue curve. At this point, MR equal to MC. So let's decide output at the point where MR equal to MC, that is the Q. So let's name that as equilibrium output level, or Q star, for a firm. Right? So this is known as profit maximizing output level. Why? If you take point like Q1, let's assume we want to produce at Q1. If we are producing at Q1, what happens? Your marginal cost, that is the cost of producing one more additional unit. Cost of producing one more additional unit is like this much. Let's say this is 10, it is 4. And cost of producing one more additional unit is 4, whereas gain for producing one more unit is 10. Because you can sell whatever with 10 rupees, because that is market determined price. In perfectly competitive market determines everything. Therefore, we have to accept the price 10. So my cost of producing next unit is 4, whereas revenue for producing that unit is 10. So that's a profit. Cost is lesser than the revenue. Therefore, we can get this much of profit. What should we do? Should we increase our output level or produce the same, or decrease our output level? Simply, we should increase our output level, because revenue you will be getting by increasing one more output unit is higher than the cost. To take a point like this, what happened? This is the cost. Let's say 9 rupee. 9 rupee is the cost for additional unit of output. If we increase from Q1 to here, we need to pay 9 rupees as the cost, but revenue is 10. Now there's a difference. So we have a gain. Therefore, what we do, we further increase. Likewise, if you are towards the left-hand side of this optimum output level, it is better to increase the output level. Now, let's take Q2. What happened? If we are producing at Q2, this is our gain, additional gain by increasing one more unit, 10 rupee. And this is the cost, additional cost to the total cost by producing one more unit. So it is like, let's say 14 rupee. If you are going to produce, what happened? You will be losing 4 rupees because your additional cost is higher than the additional revenue. Therefore, it is better to reduce your output, like this place. If you reduce that, your additional gain will be 10, additional cost will be 12. So it is better to reduce. Here, additional cost is 14. Here, additional cost is 12. Whereas we are getting 10, 10. Therefore, here 4 rupees loss, here 2 rupees loss. Therefore, we decrease the level of output. If you take one more, further we will decrease. Therefore, we say it is towards the right-hand side, it is better to decrease the output. Here it is better to increase the output. At this point, what happened? MR equal to MC. Therefore, there is no any profit or any loss. In fact, if you come from here, profit, adding, this is the point where you get the maximum point. After that, you will not be getting any profit. Therefore, we decide in any kind of a market structure, firm, remember firm, not the market, firm decides its optimum output level at the point where MR equal to MC. So this is the point where MR equal to MC. And in the perfectly competitive market, remember one more condition, that is, other than MR equal to MC, we know P equal to MR. Therefore, P equal to MC if you want. P equal to MR equal to MC. Even you can put D for the firm. Demand for the firm also equal to MC at the output level. So simply remember MR equal to MC. In the perfectly competitive market, P equal to MR equal to MC. In the optimum output level, MR equal to MC. So we get the optimum output level at the point where MR equal to MC. In this graph, it is here. Now we know why it is optimum, because this is the point where we will get the maximum profit. So after that, we will be starting getting loss. Before that, still there is a chance to improve. If you further improve, your output will be further, your profit will be further increase. But after that, if you decrease, you can reduce your loss. So therefore, we say that Q is the optimum output level. At that point, we are getting MR equal to MC. In the perfectly competitive market, especially MR equal to MC equal to P. Of course, this is a kind of a boring, not boring, it's a complicated kind of a picture, but don't worry. It's a very simple thing. But why I put it there, just to tell you, we learned in the previous slide, that is, at the optimum output level, MR equal to MC. And at the optimum output level, MR equal to MC. But we know in the perfectly competitive market, MR equal to P, marginal revenue equal to price, just because of the reason I explained in the previous slide. If it is the case, we know that P is determined by the market, not by the consumer, because we had the assumption that large number of sellers and buyers. Since we are having large number of sellers and buyers, we say that producers are price takers. Of course, consumers also price takers. They are not price makers. Either producer or a consumer cannot make the price. So, consumers and producers are price takers in the perfectly competitive market. In simple word, what it says, they accept the market determined price. That depends. Market price determined by the demand and supply, which we did. Like I asked you to draw those 36 or 38 odd graph, and I ask you to see what will happen to the price. So price will be determined by the market depending on the demand and supply conditions. So let's assume we had a market demand curve like this. Maybe let's put into one curve for easy understanding. So we were having something like this as the supply curve. Let's say due to the demand condition, we were having a demand curve like this. So market price will be equal to P. P1. This is P1. So we can extend that as MR. So this is MR. And it will be going like this. So in the perfectly competitive market, price can be like P1 for a firm. So in that case, MC equal to MR at this place. So the firm will be producing Q1 amount. So due to some reason, demand can be increased. Let's say there was a huge money printing by the government, so people are having a lot of money. So we are having P2. Now we are having increased price in the market. And this will be the new P2. MR equal to MC at this place. So this is the output. Same way, we can have here, 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 here. Either demand or supply will be changed, but depending on the demand and supply change, this will be changed. This is the only point I wanted to highlight. So here, let's assume we have the demand and supply curves. So depending on the behavior of the demand and supply curves, we will be having P1, P2, P3, P4, P5, P6 or whatever prices in the market. The firm will accept whatever the price. If it is P1, firm will determine Q1. If it is P6, firm determine Q6. Right? So with this graph, simply it says output level can be anywhere, Q1 or Q6, or further you can have further improvements here. Right? Anyway, that depends on the point where MR equal to MC. Therefore, price can be P1 or price can be P6. Now, taking that into consideration, we can have several graphs and see the outcome. Now, this is a situation like P6. Let's assume we take one scenario from the previous that complicated graph. Let's say this is P6, which is determined by the market. We had demand and supply like this. So we got P6. Firm will accept. Firm has to, because they are supplying very small amount in the market, so they cannot make any change in the market. So they accept it. MR equal to MC at this place. Right, then output equal to this much. And market price will be P or P6 and quantity will be Q. Like what we discussed in the under the final slide of the cost of production. What are these? C, D, and E. What is E? Area E, this one. And what is D? This one. And what is C? This graph says area E is below the AVC. So this area. This is the AVC. If we are producing Q amount, this is the average variable cost. That is cost per one output unit. So we have to multiply this by the number of output, then we get the AVC. So this area, this one A, this is known as AVC, total variable cost for the output unit. But anyway, simply as we learned in the previous class, this is AVC. And this is AFC, average fixed cost. And this one, nicely given the answer, that is the economic profit. Because as I previously mentioned, this ATC includes normal profit. In economics, there's a difference between cost and profit. And so when we say cost, that includes economic profit, normal profit. The profit that should be allocated for the entrepreneur is given in ATC. Therefore, area C, this is known as economic profit, which is higher than the opportunity cost. So whenever there is an economic profit, which is higher than the usual profit, then there will be a lot of competition for that. Many people will come and join this industry because you are having economic profit. Any entrepreneur would like to have the economic profit which is higher than your opportunity cost. Right? But anyway, let's keep that aside for a moment and let's take the case economic profit. So this graph tells us in the short run, this is short run because we have AVC. Concept of AVC is there. So, and AFC is here. Therefore, this is about the short run. In the short run, there can be economic profit. Simply. One conclusion that we can make here is the in the short run, economic profit can be there. So this is the economic profit. Economic profit means profit higher than the opportunity cost of the entrepreneur. Now then, if you take this one, what happened? Let's say we were having demand and supply curve like this. So this was the P6, which is determined by the market. Now there is economic profit. When there is economic profit, what happens? Lot of suppliers will come and join this industry because remember, we have free entry and exit. If there is free entry, what happens? If there is free entry, when there is economic profit, many firms will come and join this industry to get that economic profit. When they come and start supplying, what happened to our supply curve? Supply will be increasing like this. And supply will be increasing like this. And this will be P5. So this was P6. Now we get into P5. This is P5. Right. Then we are having new MR. This is our new MR. This is P6. Sorry, P5. This is P5. Now we are getting the new MR. Now we have MR equal to MC at this place. So the producer accepts the price given by the market. Market determine price as P5. Then P5 equal to MR. So MR equal to MC at this place. And we decide our output at level 2. Right? If it is the case, we have two areas again. Area D, which is AVC, and area C, AFC. So the total area is known as total cost. Right? In this case, total cost equal to total revenue. This also can happen because market determines price. Value is determined by the market, therefore we accept that. So it can happen. If it happens in the market, is there any profit? There is profit. There is profit because we get this point where we are recovering all our cost. In economic, cost includes opportunity cost of the entrepreneur. Since cost includes the opportunity cost of the entrepreneur, that will include the profit. Therefore, if price is like P5, we recover all our cost, including cost of the entrepreneur. So profit is there. But remember, that is the normal profit, not economic profit. So it is the normal profit that firm will earn. And we will continue to produce. So this tells that in the short run, we can earn profit. The previous one, it says we can earn economic profit. This says we can earn profit. Let's assume due to some reasons, there were some other suppliers joined with the industry. Now, supply will be shifting further rightward, or maybe demand decrease. This is because of the pandemic. So we have decreased demand. When we are having decreased demand, then price will decrease. So this is P3 or P4, or let's say P3, and price decrease to P3. Now we have new MC equal to MR at this place. MC equal to MR at this place. So output equal to Q at this point. Output equal to Q at this point. This is the point where P3 equal to MR. Now, this D is known. That is AVC. and this C is AFC. With the price P3, we can get recovered the AVC. But can we get recovered our FC in this case? In this case, we are not recovering it because price is equal to P3, which is less than, this is the AVC. Average variable cost is this much. Therefore, if this firm continue to work, it will be earning loss like this. And this also can happen. In the perfectly competitive market, again, price is determined by the market. Therefore, we have to accept the price. If market determine P3, we have to accept the price as P3. P3 equal to MR, therefore, MR equal to MC at this place, so our output will be, right? So, we will be earning losses. This tells we will be earning losses in the short run. So, by now, we know we can earn economic profit, we can earn profit, and we can earn loss in the short run. If we further goes down, even it can be like this, right? So P equal to, let's say this is P1, MR equal to MC at this place, so output is Q. We are not earning our AVC. And this is the AVC, and so this is the total AVC or the AVC, and this is part of it. So we are getting part of AVC, but not the whole of AVC. Can this be happen in the market? If this is the case, let's assume price equal to P1, which is given by the market. We have no any argument here. We have to accept the price because we assume that in the perfectly competitive market, we assume the market given price. So P equal to P1, therefore MR equal to P. If it is the case, we are getting MR equal to MC at this place, right? MR equal to MC at this place, and output like this. So the question, can we have this kind of a scenario in the perfectly competitive market in the short run? Any idea? Okay, very good. Yes, we cannot cover any cost. The answer, yes, it is given. Now, if you look at this scenario where the total average variable cost, that is the cost that we incur because of getting into the production. Like if we take our cafeteria owner's case, it is the cost of rice, meat, vegetable line. Those costs will be borne only if he get into the production. If we get into the production, if the price is like P1 in this case, then if it is P1, we will not be recovering our variable cost, which is the cost for this vegetable, meat, and rice. So some part of that cost is not taken. Therefore, if the price is like P1, we will not be continue with the production because we have pre-exit. We had the free entry, also we are having pre-exit. Right? There is no any barriers. There are no entry and exit barriers. Therefore, whenever we get the loss, we can move away from the market. When we move away from the market, then supply will be moving leftward. So price will be increased. Right? So some firms will get away from the market. With that, price will be moving leftward. The supply curve will be moving leftward. Finally, price will be going up. If it is the case, we may get into a scenario like this. Let's say this is P2. Now price is P2. Will we be continuing in the market? In this case, yes. Right? This is very important. Remember, if the price is below the AVC, when price goes below the AVC, of course we stop the production because we are not recovering our variable cost. But if price is in between AVC and ATC, which means we cover AVC, no issue with the AVC. Variable cost we cover. And also we cover some parts of the AFC. This much of AFC is not covered. And if I want, I can put this as C1 and this is C2. So if the price is like P2, then C2 is recovered. C2 part of the AFC is recovered, whereas C1 is not recovered. But if we do not get into the production, already we have borne this cost, which is known as fixed cost. And when fixed cost is there, we have already borne that, irrespective of the amount of output. Therefore, whether we produce or not, we have to bear C, the total area of C. Therefore, if we stop the production, our loss will be this much. Total area of C will be the loss. But because of now we are getting into production, our loss is limited to some part of C, like this area. So therefore, remember, in the perfectly competitive market structure, if price is little bit higher than the AVC, so this is the minimum point of AVC. If it is little bit higher than the AVC, we continue to produce. Because in the short run, we can earn loss. And in the short run, we can earn loss. But in this case, what we are doing, we are minimizing loss. Here we are maximizing profit. Here we are just earning the normal profit. In this area, what we do, we minimize our loss. If we do not get into the production, total loss will be the total fixed cost. If we get into the production, some part of fixed cost is recovered. So therefore, we will continue in the production. So with that, we can get into one more situation, this one. MR equal to MC at the minimum of ATC here. At this point, we are indifferent whether to produce or not. Right? If it is a little bit higher than that, we produce. If it is less than that, we stop our production. Therefore, in business world, this is called BEP, or break-even point. Right? Break-even point is the minimum of AVC. If price is higher than that, we continue the production. If it is less than that, we stop the production. Therefore, remember, minimum of AVC is known as the BEP, break-even point. That is the point that we decide to produce or not to produce. If it is less than, we decide not to produce. If it is more than, then we decide to continue on the production. So with that, we can get one more nice thing, that is this one. If you want to generate the supply curve, which we simply took in our analysis up to now, that is the MC curve above the minimum of AVC. Right? So we got the minimum of AVC here. So the MC curve above the minimum of AC is known as the supply curve of a firm. So this is the supply curve of a firm. Then what we do, we add up all these curves. And this is, let's say, firm 1. Likewise, we have firm 2, 3, 4, likewise, n number of firms. Then what we do, we add up all these firms horizontally. And then we get the market supply curve. So this is why market supply curve is something like this. Right? So therefore, this is the horizontal summation of all the MC curves. With this, what we learn that in the perfectly competitive market, in the short run, there can be economic profit, there can be normal profit, there can be loss. And the price can be anywhere above the minimum of AVC, because the minimum of AVC is known as BEP, or break-even point. If our price goes below the BEP, we stop our production. If our price goes above the BEP, we continue to produce. We can get into the long run equilibrium. In the long run, what will happen? In the long run, what happens? A firm in the perfectly competitive market can earn economic profit in the long run, short run, as we learn. Then what happens? The other firms in the market or other firms in other industries will get to know that there is economic profit. When they feel that there is economic profit, these firms come and join in the industry. So therefore, supply will be increasing. It will be moving rightward, as we discussed. Right? Supply will be moving rightward. When supply moving rightward, price will be getting decreased. So it will be decreased until the minimum of AC. Why it is until the minimum of AC? You just imagine the case with any losses, incurring losses. A firm in the perfectly competitive market can earn loss in the short run. But we have free entry and exit again. If they earn losses for a long time, then what they decide? They decide to move away from the market and from this industry. Some firms, those who are engaged in this industry, will move away and will join with some other industries. Then what happens? Supply will be decreasing. When supply decrease, price will be going up, and it will be coming until the end of minimum of AC. If it is going more than that, then the economic profit is there, new firms will join. If it is going below that, economic loss is there, existing firms will move away from the market. Therefore, remember, price will be determined at the minimum of AC in the perfectly competitive market. In the perfectly competitive market, price will be at the minimum of AC. So we are getting the price at the minimum of AC. So MR equal to MC at this place, because as we discussed previously, the long run cost curve will be consisting of several short runs. If you want, you can do them. So we are having AC and MC, AC and MC, AC and MC, likewise. Right? So we are having our MC equal to MR at this place. Right? So price of a perfectly competitive market will have the minimum of AC in the long run. So this is the beauty or the advantage of a perfectly competitive market, because if we allow for the competition, price will get to the minimum of cost. In fact, that is the minimum cost the product can be supplied in the market, and including normal profit. So here there is no economic profit, there is no any loss, but there is normal profit. So we believe that if we get the minimum of AC, we get the normal profit. So this is the behavior in the long run equilibrium, where we have P equal to MR, which we learned previously. Then it is equal to MC. So we learned that P equal to MR equal to MC. Then that is equal to the ATC in the long run. So that is the short run ATC, which is also equal to the long run AC. Okay, so if I summarize the perfectly competitive market, what I wanted to tell you with all these discussion, in the perfectly competitive market, there are certain characteristics or the assumptions which are very important in determining the type of the market. Like there will be large number of small sellers, large number of small buyers. So with that, we wanted to say that market share is so small for a particular producer or for a particular consumer. He or she may not be able to make any impact on the price because the amount is so small. Nobody cares. The other one, we are having free entry and exit. Anyone can join the industry, anyone can move away from the industry. So if there is economic profit, what happens? Many people come and join with the industry to reap the economic profit. On the other hand, if there is loss, some people move away from the market. So therefore, in the short run, a firm which is running on the perfectly competitive market can earn economic profit, or can earn normal profit, or can earn loss, because we will continue to produce if our price is higher than the minimum of AVC. That tells us if we are recovering at least our AVC, we tend to continue our production in the short run. So this simply I said some part of AFC. If we can recover AVC plus a little bit of AFC, then we will continue to produce. So we can have loss. Then we got about the break-even point. That is the point where we will be recovering at least AVC. That is the break-even point. If price is higher than BEP, we continue to produce. If it is less than BEP, we stop our production. So with that, we got into the long run equilibrium. In the long run, what happens? We will be getting into the minimum of AC. And we are getting into the minimum of AC because if there is economic profit, new firms will join in the industry. That will increase the supply, prices will be shifting down, and we will be getting into the minimum of AC. If price is below that, some firms will move away from the market, and finally we will be getting the price at the minimum of AC.